Hello people, hope you're all doing good. So today we'll be covering FR ka MTP 1 and MTP 2 in this particular session. Overall pretty straightforward MTPs. 2-3 questions you could say, maybe slightly different, but otherwise rinse and repeat the old, more or less are repetitive. Yes. So now we'll be covering in this particular session only the new questions. If it's a similar one, we'll not be doing that. Okay, let's dive into the first case, a straightforward one. X is engaged in many business, it seems fine. They're in the process of acquiring fixed assets and intangible assets. Story they have given. Okay. X is paid. In fact, as I said, when you read the case study, it's always better first you read the requirement and then go back to the case. They're saying some cash flow, which activity you will show. And again, there's again a cash flow wala question, maybe operating, in investing or financing. And some revaluation of trademark question they're asking. Some revaluation of patent they're asking. Some revaluation and patent and something relating to identified asset. Ind AS 115 ka maybe. Yeah, these are the case ka requirement. Now the company has paid advance tax of 5,30,000. Normally tax paid we show it under operating activity. But in this 30,000 is for long-term capital gain. So long-term capital gain comes when you sell a PPE. So if PPE is sold as an investing activity, the long-term capital gain tax paid on that is also investing activity. That means in this 530, 5 lakh you will show it under operating activity and 30,000 under investing activity. That should be the right option. So 5 lakh operating, 30,000 investing. That's all. That was a requirement. Okay. X acquires fixed asset of 10 lakh from Y by accepting liabilities of 8 lakh of Y and balance to be paid in cash. Now we bought asset worth 10 lakh. So we have to pay 10 lakh. To whom? Y. Now Y had some 8 lakh worth of liability. They had some creditors whom Y had to pay 8 lakh. And X told Y Limited, I will pay your creditors 8 lakh in future. Whatever. So we accepted liabilities of that. That means balance, how much is payable? Balance is paid in cash. So 2 lakh only we paid in cash. Though we bought fixed asset worth 10 lakh, cash outflow is only 2 lakh. So 2 lakh will be shown under investing activity as an outflow. That's the answer. So only 2 lakh will come under investing activity. 8 lakh is a non-cash item. It will not have an impact on cash flow statement. Okay. Next, we've acquired a trademark for 1 lakh. First year, we are on 31st March 20x1. End of first year, from 1 lakh, it has become 1,20,000. So it's a first time you did revaluation and you got a gain. That gain will be transferred to revaluation reserve 20,000. This is first year ka drama. Second year, when you did revaluation, from 120, next year it became 85. From 120, it has become 85. Okay, correct. No? Yeah, this only. Yeah, yeah. But now 120, 85. That means the loss is how much? Basically 35,000. 35,000 is a revaluation loss. So second year when you did revaluation, you got a revaluation loss of 35. Will you transfer this to SPL? No. First we will adjust with RR 20. Balance loss 15. You will transfer it to SPL. That was a requirement here. This is for 31st March 20x3. That's the next case study requirement. As on 31st March 20x3, how the revaluation will have an impact. Revaluation will impact RR. Out of total loss of 35, 20 you'll adjust with RR, 15 you'll adjust with SPL. Which option has that? 20 with RR and 15,000 with SPL. That's the right option. Okay, very simple thing, nothing to break our head. Same for patent. We purchased for 1 lakh first year. At the end of first year, it became 1 lakh became 85,000. So for patent, when you did first time revaluation, it's a loss. From 1 lakh, it has become 85. So revaluation loss is 15. First time when you do revaluation and get a loss, it will be transferred off to SPL. Correct? Okay. Second year when you did revaluation, from 85 it became 105. So it's a revaluation gain worth how much? 20,000. So when you get a revaluation gain next year, will you straight away transfer it to RR? No. It's a ulta process. Whatever you have done before, undo that and then do it. First time you had booked a loss of 15. No? So now when you get a gain of 20,000, book 15,000 gain first. You will book it with adjusted with SPL because your book lost to that extent earlier. Balance gain only you will transfer to revaluation reserve OCA. So this is the option. That's what they've asked. Check. Patent for second year when you did revaluation, how it will have an impact. 15,000 you will book a gain. 15 out of 20 increase you will adjust in SPL. 5,000 you will adjust it with RR. Very chota mota questions. Nothing there. Now X has entered into some 10-year contract with A for the use of rolling stock specifically designed for X. So on customized asset, we are selling it to one particular debtor of ours. That is called rolling stock. The rolling stock is nothing but to transport the goods from one to another, no, especially to place the goods in shelf and all. You take that machine that will take that particular goods and put it in the respective shelves. The rolling stock is designed to transport the material in XCA production process. and is not suitable for other customers. So it's a customized asset. The rolling stock is not explicitly specified in the contract, but A owns only one rolling stock that is suitable for X Limited ka use. Which rolling stock, clearly they have not mentioned, but we as a seller, we have only one that particular goods or one particular equipment which is suitable for our customer. So they are asking, is this and if the rolling stock does not operate properly, A Limited has to replace it or repair it. Now the question is, they're asking, is this rolling stock an identified asset? Are you able to identify it? Though the asset is not specifically called out in the contract, since it's a customized asset and we have only one such customized asset which will suit the customer, this rolling stock will be considered as an identified asset. Okay, for Ind AS 115 ka revenue recognition purpose. That's all. All right. Second case study is not required. It's the same question we have done, so that's fine. Third case scenario is also repetitive, not required. It's the same one. Okay, case scenario number 4, we will take it up. On 1st April 20x1, the company has issued 30,000 6% debentures of 100 each. So 30,000 into 100 will give you 30 lakhs, and it is issued at par. The debentures are redeemed at 10% premium on 31st March 20x5. From here to here, if you count, from 1st April 20x1 to 31st March 20x5, it's a period of 4 years. So the redemption will come 4 years later. Okay. Or this may be converted into ordinary shares. Either we will pay cash and redeem, or we will convert it into equity shares. Fine. Option is with the holder. The interest rate for equivalent debentures without conversion biscuit is 10%. If we had not given this conversion option, that interest rate would have been 10. Because we have given this conversion option, the investors are ready to accept 6%, right? So obviously this is a compound financial instrument, you need to split. Okay. Now what is the question? Now the date of transition to Ind AS is 1st April 20x3. So this is Ind AS 101, first time adoption of Ind AS wala case based. Sir, debentures has been this convertible debentures has been issued on, or the CFI, compound financial instrument, they have been issued on 1st April 20x1. They will get redeemed or cancelled on 31st March 20x5. But between these two dates, we have a transition. From AS, we have shifted to Ind AS. Now we know this transition provision. In accounting standard AS, we don't have compound financial instrument ka accounting. As per Ind AS, compound financial instrument has to be split between equity and financial liability, right? That split accounting is not there in AS. Now from AS, we are shifting to Ind AS. Now this instrument, should we do that split accounting, is the requirement. Now if you study Ind AS 101 provision, we have studied this. If this compound financial instrument, if it is not outstanding on the date of transition, if the CFI instrument, if it is not outstanding on the date of transition, then splitting between equity and financial liability not required. Meaning, if this instrument is already repaid, if it is already redeemed before the date of transition, then since we don't have that instrument, splitting that instrument between equity and financial liability not required. But here the redemption date is 31st March 20x5, but date of transition is 1st April 20x3. On the date of transition, that is 1st April 20x3, this instrument is not fully repaid. It is still outstanding. Now, in that case, make equity and financial liability ka split, you have to do it. You cannot escape. All right, how to do the split? Same thing. How do you measure initial value of financial liability? Present value of future cash flows discounted at market rate. What are the cash flows associated with this instrument? 30 lakh into 100 if you do, you'll get 30 lakh. That's a face value of the instrument. Actual interest you're paying is 6%. So 30 lakh ka 6% if you do, interest payable is 80,000. Interest you have to pay for all the 4 years. So we will take PVAF. At 10%, take PVAF for 4 years. That will be this. Okay, this is present value of the interest element. Plus, since it's optionally convertible, we will also take present value of principal. Principal, you will not repay 30 lakh. You are redeeming it at premium. 30 lakh plus 10%, which is 33 lakh. This will you pay every year? No, we will pay only once. When? After 4 years. At the 10%, PVIF you consider for 4th year only, which is 0.68. You will get this. This will be the initial measurement of financial liability, meaning this will be the value of financial liability on the day you issue, which is 1st April 20x1. But your date of transition is not 1st April 20x1. It is 2 years later, 1st April 20x3. There afterwards, for financial liability, you go for ACM accounting. No? So put up ACM table for 2 years. Why? Because after 2 years, 31st March 20x3 will come and you will shift over to Ind AS. So only 2 years ACM table is good enough. Opening balance is this. You book finance charges at effective interest rate or market rate here 10%. Payment you have to make is every year ka interest. And these two ka addition minus payment will give you closing balance. First year ka closing will become second year ka opening. This ka 10% minus 180 will give you closing balance. Okay. Now, since this instrument is not repaid on the date of transaction, you have to show financial liability in your books on the day you shift to Ind AS. The day you shift to Ind AS, financial liability will come in your balance sheet, date of transaction balance sheet at this particular value. That's all it is. Okay, for equity, anyway, there is no remeasurement concept. Okay, now what is the requirement of this question? They are saying, how should you account it? First option is, since the liability is outstanding on the date of transaction, the company needs to split this debentures into equity and financial liability. That splitting you cannot ignore, you have to do it. Okay. Second requirement, they ask with respect to financial liability, okay, what would be the amount of financial liability on the transaction date? This financial liability will be recognized at 30,27,666. That's the option. That's all. Okay. Now, that's it. Beyond this, they did not ask anything. They did not ask the equity portion. So it's fine. All right. That's all. Okay, with this case study portion is done. Now moving on to the descriptive, first question is NR. NR is not required. Similar question we have. We are only doing the new questions in this MTP. Second question, excuse me. On 1st April 20x1, bank provides a entity with a 4-year loan of 5,000 under the normal market terms. Bank will not give you the loan at off market terms. No, it will happen at market terms only. Okay. Fixed interest charge is 8% and interest is payable at the end of each year. And this 8% is a market rate is what they are saying. Okay. All right. The transaction cost is 100. And when you take a loan, there may be some processing fees and all. No? So that transaction cost is 100 over here. Okay. Because there is a transaction cost, the actual rate or market rate and effective interest rate will not be same. Market rate of interest is 8%. Actual and market rate is 8%. But because we have transaction cost, they have given effective interest rate to be 8.612% because we are paying processing fees also more now. So the cost is more. Okay. On 20x1, x2, that is first the year we took the loan, the entity had some financial difficulties. On 31st March 20x2, at the end of first year, the bank agreed to modify the terms of the loan. Whatever loan terms we had, we are planning to shift it. Under the new terms, the interest payments for year 2 and year 3, next to 2 years ka interest, from 8% we made it to 5%. Okay. Loan has been changed. The entity paid a fee, bank fees of 50 rupees for paperwork relating to modification. Now they are saying whether this modification constitutes an extinguishment of original financial liability or not. It's a modification or extinguishment of accounting wala concept, right? Whenever financial liabilities have been modified, terms have been modified, we either do modification accounting or extinguishment accounting. If that modification, we calculate something called percentage. If that percentage is 10% or more, extinguishment accounting. Less than 10, we do modification accounting. We have to find this. This is a very simple question also, right? Okay, let's find out. Okay. Sir, since there is transaction cost, though you took a loan of 5,000, you will not show financial liability at 5,000. We'll have to do the accounting for the entity, not for the bank. For an entity, it's a loan taken. So it's a financial liability. Initially, if there is any transaction cost, what do? Reduce it. For financial asset, we add the transaction cost. For financial liability, we reduce. From 5,000, reduce the transaction cost of 100 and it will become 4,900. Okay. All right. Now this modification drama came at the end of first year. So first let's know what is the value of financial liability in our books at the end of first year. So put up ACM table for 1 year. Opening balance of the loan is 4,900. Finance charges, you will book it at effective interest rate of 8.612%. Payment is what? 5,000 ka 8%, which is 400. These two ka addition minus this gives you closing balance. That is the value of financial liability. Correct? Okay, currently in our books, financial liability is shown at this balance. Now we have done a modification. For this, what you have to do? Find out what? The present value of future cash flows you find out under the new terms, but by using old EIR. First, you find something called present value of future cash flows under the new terms, but by using original EIR. Under the new terms, how much will be your cash flow? Under new terms, you will not pay interest at 8%. From 8, it's been shifted to 5. Okay, so 5,000 is the loan amount. Interest rate is 5%. Okay, how much was the loan of this? Originally, when you took a loan, it was a 4-year loan. 1 year is already over. So the remaining term is 3 years. So 250 rupees interest you have to pay for next 3 years. It's the same. Use original EIR only. So since this interest payment is same every year, we will use PVAF at original EIR for 3 years. Okay, and then principal you will repay after 3 years 5,000. 5,000 you will pay only once. So we will use PVIF at that particular original AIR for third year, because in 4 years, 1 year is already over. So third year ka PVAF, PVIF you find out. Okay, plus since there is a modification over here, due to modification, you're paying an extra of 50 rupees. Since you're paying extra 50 rupees now, this is already on present value terms. So directly add the charges. You don't have to find any present value of this because you're paying this charges now only. These are the total cash flows that will happen under the new terms, but by using original EIR. Okay, fine. Now compare our existing financial liability with this new cash flow terms. Okay, these two you will compare and get that percentage. Like currently financial liability existing in our books is 4922. Under new terms, the value of the liability is 4590. Find out the difference of these two. These two ka plus minus difference, if you find, you will get 332. Now this is difference in amount. We want the difference in percentage. To get difference in percentage, what do? Take the difference in amount divided by original amount. This is the difference in amount divided by original. Original amount means before modification, what is our financial liability ka balance? 4922. 332 divided by 4922 into 100 if you do, you will get 6.74 percentage. Since this percentage is not exceeding 10, you don't follow extinguishment accounting, you do the modification accounting only. That's all we had to tell, whether we will do extinguishment accounting here or not. We will not do extinguishment accounting. Okay, we will just do the modification accounting. And all this we have done like at least 2-3 questions in our regular notes, how to do the accounting. That they have not asked. They only asked whether it is extinguishment or not. Sorry boss, it is not extinguishment accounting. Okay. Moving on to the next question. Company is there, they are a manufacturing company, it seems. Their operating cycle is 15 months. We don't know. Anything within operating cycle is a current asset. Anything beyond that is a non-current. It's the same for current asset and current liability also. Okay. Alright. They have given some data. You just need to find out whether the component is current or non-current. That's all. Keep this in mind. Operating cycle is 15 months. A company has received a contract for 10 crore rupees at the end of current. This is our current year ending. So we have received some contract. The terms of the contract require company to make security deposit of 20% of the contract value. 10 crore is contract value. 10 crore ka 20% is 2 crore. So in order to get this contract, we have to give some deposit. So we have given 2 crore deposit now. Okay. So that means we have a contractual right to receive the cash. So it's a financial asset. Correct. No, we have deposit given. This contract will be completed in about 14 months. The contract duration is 14 months. 70% of the deposit amount is 2 crore. 70% of the deposit will be refunded immediately, meaning when the contract gets over, that is in 14 months, we will get 70% of the deposit. Balance 30% will be refunded 3 months after the completion of contract. Now company wants to show entire 2 crore as non-current asset. Is it correct? No. Sir, something which is within operating cycle is a current asset. No. Now out of this 2 crore, okay, 70% you will get it when the contract gets over, you will get this amount immediately. Contract will get over in 14 months. Okay, and operating cycle is 15 months. In 14th month only, you will get 70%, which is what? 1.4 crore. Since this 1.4 crore you are getting within 15 months, which is operating cycle, this 1.4 crore you'll have to show it as a current asset. Okay. A balance 30% you will receive 3 months after the contract. Contract duration is 14 months. Balance 30% you will not get immediately. You'll have to wait 3 months after contract ends. So 14 plus 3, which is 17th month. Balance 30 lakh. Okay, or balance rather 60 lakh, you will get it on the 17th month. But our operating cycle is only 15 months. So this portion will have to be shown as a non-current asset. Company is saying entire thing I will show it as non-current. That is not acceptable. So 1.4 is current, 60 lakh is non-current. That's all. Okay. Alright, the company has some trade receivables that are due 14 months from the balance sheet date. Okay, but they are within operating cycle. And company is saying I will show it as current asset. Is this acceptable? Yeah, since operating cycle is 15 months and we will receive money from our debtor within 14 months, it is within operating cycle. So management decision of showing this debtor as a current asset is absolutely correct. Yes, it is right. That's all. You just need to comment whether the classification is right or wrong over here. Next case. In the normal course of business, company has given 2 contracts and received a total security deposit of 4 crore. 3 crore is received from X, 1 crore is received from Y. Okay, total security deposit, the company has received Company has given 2 contract and received a security deposit of 4 crore. Company has not paid the deposit. We have collected the deposit. So it's a financial liability. First total deposit value 4 crore. In that 3 we have received from X, 1 we have received from another customer called Y Limited. These are repayable on completion of contract. However, if the contract is cancelled within the contract term of 18 months, the deposit becomes payable immediately. We will pay these deposits, okay, when the contract ends. Okay, but by chance, and the contract term is 18 months. But by chance, within 18 months only, before contract ends only, if by chance contract gets cancelled, then you will have to repay it immediately. Company is positive about the contract with X Limited, but it is in doubt about contract with Y Limited. X Limited company feels we will continue the contract, cancellation will not happen. But when it comes to Y Limited, we don't know. We feel there might be a chance of contract getting cancelled within 18 months also. The company wants to present 3 crore as non-current. X ka advance they want to show it as non-current. Y ka advance of 1 crore they want to show it as current. Is that acceptable is what they're asking. No people. Both you will have to show it as a current liability here. Why? Sir. Now, if by chance X ka contract, Y ka contract, both gets cancelled immediately. Can the company say, no, I will pay after 18 months only? No. The moment contract gets cancelled, you have to pay the amount immediately. You don't have the right to defer. Sir, current, if you want to classify something as a non-current liability, company should have an unconditional right to defer the payment beyond 12 months from the balance sheet date. Meaning, company should have a right to delay the payment 12 months from the balance sheet date. Here, company does not have a right to delay. If contract, whenever contract gets cancelled, whether it is 5th month, 6 months, 10 months, 18 months, whenever contract gets cancelled, immediately we have to pay both the advance. Hence, both the advance should be shown as current liability because company has no option to defer. Whether contract will continue or not becomes irrelevant over here. Since it is, if contract gets cancelled, you have to pay it immediately. Both these deposits will be shown as a current liability only. Okay. All right. Now, company is planning to replace a machinery. It has given an advance of 1 crore for purchasing new machinery, and new machinery will be delivered in 6 months from the date of balance sheet. You have given an advance, no? Okay. It has sold the old machinery for 0.5 crore and the payment of which is due within 10 months from the date of balance sheet date. The company wants to present both these amounts as current since they'll be settled within 12 months from the reporting date. People, one, we have sold an old asset, okay, and for 0.5 crore, we feel we will receive that money within 10 months. Yeah, we will recover the money. We will recover cash within 10 months. Our operating cycle is 15 months. So this particular, whatever amount we will recover relating to the asset sold, that you can show it as current asset. Okay, because you have sold an asset, money is yet to be recovered and it will be recovered within 10 months, and 10 months is within operating cycle. So this is current asset, correct? But whatever deposit you have given for new machinery, 1 crore, that cannot be shown as current asset because it's a capital advance. See here, you have given an advance of 1 crore, right? In return, you are not going to get cash, you will get an asset. An asset will not just stay in the business for 1 year. Asset is expected to stay longer, no? PP will stay for more than 1 year. Hence, what we say is any capital advance given, meaning if you have given any advance for tangible asset, intangible asset, investment properties, etc., capital advances are always non-current asset because you will not get the money back. Rather, you will rather get the advance. This is an advance for the asset. After some time, you will get the asset. An asset is expected to stay in your business for a lot longer. Hence, capital advance given by default is non-current asset only. Okay. All right, people. Fine. Okay. Question 3. This is actually, I would say, a little good question comparatively. The rest are all pretty okay. On 1st April 20x3, Jackson purchased some land for 10 million. One company, they have purchased a land. They have purchased this land in order to build a plant for manufacturing generator parts. So they have purchased this land so that they can make a factory out of on this land and produce a product called generator parts. Okay. That means this land cost is necessary for factory to or this plant to operate in a manner. No? So this land cost becomes a DAC. Okay. During the 6 months ended from 1st April to 30th September, Jackson incurred a cost of 3.5 million in preparing the land and erecting the structure for the plant. In order to construct this particular plant, it took about 6 months and we spent 3.5 million. This is your directly attributable cost. Okay. Fair enough. Okay. Basically here you just need to say how all this transaction has an impact. Now people, is land necessary to construct the factory? Yes. So land cost can you add? Yeah. Land ka purchase cost is necessary for factory. So I add it. And you constructed a factory at what cost? 3.5 million. That also you can add because it's a directly attributable cost. Okay, that is also sorted. Then this process cost, this erection process or this factory wala construction, no, it caused some damages to the land. This process caused some damage to the land for making it suitable for setting up the plant. Because you built a factory on this land, some damage has been caused to the land. Jackson began operation on 1st October. From 1st October, 6 months we took the time to make the asset ready. Then onwards, from 1st October, asset is ready to use and the life of the asset is 10 years. This is relevant for depreciation. Depreciation starts from the day asset is available for use. From 1st October, you need to charge depre and life is given to be 10 years. Now, Jackson, the company, they are legally obliged to rectify the damage caused to the land for setting up plant. Excuse me, because the damage has been caused to the land, the company has a legal obligation to rectify this. So this is your DSR, decommissioning and site restoration cost. The directors have given the rectification cost after 10th year. So rectification you will do after 10th year when factory usage comes to an end. That is on 30th September. Because asset was ready by 30th September, no? 30th September 20x3 it was ready. So 10 years from this date will be 30th September 20, maybe if you call X as 1. So 30th September 2013 if the asset is ready to use. On 30th September 2023 we'll have to rectify because life of the land is 10 years. Now they're saying it will cost 3 million to rectify the damage caused for the preparation of the land. Okay, this 3 million when you will incur after 10 years, correct? No, but DSR cost, can you add it to the cost of PP? Yeah, since this damage is cost due to setting up plant only, this DSR cost is related to PP. So we can add this, right? When on the day you recognize the asset is ready to use on 30th September 20x3. On 30th September 20x3 only, in fact, it's not 1st April, sorry, my bad. This is 30th September. Okay, on 30th September 20x3, you will make provision for DSR. Okay, how much? All right. This 3 million, can we add 3 million DSR cost? No, 3 million is a cost that you will incur not now, after 10 years. So we have to find present value. Okay, that they have given. Check. The rate here is 12%. The present value annuity, present value of one payable in 10 years time with at 12% is 32.2 paisa. Okay, we want it in rupees, no? 32.2 paisa will be, if you divide 32.2 divided by 100, it will be 0.322. So the discount factor, the PVIF at 12% after 10 years is this. Okay, this is a future value. Multiply by the discount factor, you will get the present value of the DSR cost, which is 0.966 million, which you can add. Okay, you will do all this activity on 30th September. Keep that in mind. Okay, maybe if you want to write it here on 30th September 20x3. Okay, G. All right. Great. Next, the asset is ready now. And one more cost is there. 0.2 million for each year to rectify the damage cost owing to effluent generated out of the production process of the plant. Now, after you start, because you constructed a factory, land got damaged, which we have a legal obligation to repair, and that repair cost will be 3 million. Okay, this has come due to setting up of a plant. Now, after you start using a plant also, there will be some damages. So in order to rectify those usage damages, now PP is already ready. Now we are using the PP due to that usages, no, maybe you produce some product, right? So due to that, some damages has been caused. That also you have a legal obligation to rectify. That rectification cost is 0.2 million for each year. Okay, but this is not related to PP. Do you agree with me? Because PP is ready by 30th September, right? By 30th September, PP is ready. Right? This damage has been caused after you started using the PP and for producing a particular product. So this is not related to PP. Yes, for this also, since we have a legal obligation, we will make a provision. But this is not provision for DSR because it is not related to PP. That you cannot add. That's the reason if you just check, I have not brought this calculation here. Because this is due to the production process. Because you produce the goods, you are incurring this. So if it is related to goods, you'll add it to the cost of inventory. We have studied this. Any DSR cost related to PP, you'll add it to the cost of PP. Any DSR cost related to the cost of inventory, we'll add it to the cost of inventory. Here they have not given full information about that, so I'll not comment on that. But we know for a fact that this is not related to PP. Okay. All right. Now PP ka first drama we'll do. This is the carrying amount of PP on 30th September. Carrying amount of PP on 30th September 20x3. Okay, adding all this, you will get this much amount. Okay, now our current year ends on same 31st March 20x4. They must have given that somewhere. Okay, no problem. Yeah, current year has ended on 31st March 20x4. So in the current year, will you charge any depreciation? Yeah, asset is ready by 30th September. Okay, so you'll in the current year you'll charge depreciation from 1st October to 31st March, which is 6 months. Okay, what? Now don't take this value and calculate depreciation. Okay, though this is the plant ka carrying amount, this includes land. Land we don't depreciate now. So from this particular value, plant ka total value, land ka cost you eliminate, because even land is also necessary for factory construction. No? So land ka cost you eliminate. So this is the depreciable amount. Land we don't depreciate. Residual value not given, so 0. Divided by life, which is 10 years. If you do this, you will get depre for whole year. But current year we charge depreciation only from October to 31st March, which is 6 months. So 6 months depre will be this. And after depre, this is the carrying amount of the asset that will get reflected in your balance sheet. That's all. Okay, sir. Sir, what about this, sir? 1 minute. First, I'll just drop a timeline for you so that we'll have a think. Sir, we purchased the land on 1st April 20x3. Factory was completed by 30th September 20x3. On this land, you construct a factory on 30th September 20x3. Okay. Because you constructed a factory on the land got damaged, and that you have to rectify it. When? 10 years from this date, because once a factory is available for use, it will run for 10 years. So on this day, damage was caused due to land construction, and on this day, 10 years later, you will rectify that particular damage caused to PP. Hence, it is 10 years. Okay, that is about 3 million that I'm talking about. Okay, now people, once the asset was ready to use, our current year ends on 31st March 20x4. Now for 30th September to 31st March 20x4, 6 months, you have used the PP. From here to here, you have used the PP. Since you have utilized the PP, some damage has come. Due to that production process, some damage has been caused. If due to production process, if there's any damage caused, for that also we need to make provision. Though it is not related to PP, but we still have an obligation. Now when will you make provision for this? This 0.2 million ka provision, you will not make it on 30th September. Because that provision will only arise when you start using the product, because damages will be caused after using. In the current year, we have used it for 6 months. Okay, because you have used as factory for 6 months, okay, and generated some particular product, due to that production process, some damages has been caused, which we are legally obliged. Okay, fine. So for that second provision, we will not make it on 30th September, because on 30th September, we did not start using. Well, we have not yet fully used, right? On 30th September, asset was ready to use. We used the asset for 6 months, and due to that production process, some damage has been caused. And we have a legal obligation to rectify it. So on this particular day, 31st March 20x4, we need to make provision for 0.2 million each year. Okay. But when will you incur this? This rectification cost also will come on 30th September 20y4. I'm taking X, maybe if you want, if X is confusing for you, you can take as 1. Is this, if you take as 2013, this will be 30th September 2024, like this. Okay. Now this you can treat it as 31st March 2014. Now from here till here, if you count, it is not 10 years, it is only 9.5 years. Okay. Right? Correct. No, because this particular, one second. This particular damages, 0.2 million ka damages will only come when you use the factory. In the current year, you use the factory for 6 months. Okay, from here to here, you have used the asset. All rectification work will be done on 30th September 2024 only. But you have already used the asset for 6 months. So currently, you are on this date. Some damages has been caused due to production process, which you have to rectify on this date. From 30th March 2014 to 30th September 2024, if you count, it is not 10 years. 6 months is already passed. So 9.5 years. So you need to make provision for that by considering period as 9.5 years. So that's what they've given here. For 9.5 years, what is PVIF? At 12%, the PVIF for 9.5 years is 34.1 paisa, which is 34.1 divided by 100. If you do, you'll get 0.341. Okay, so you'll have to take 0.2 million. Okay, this is the provision for damages due to some effluent production or whatever. 0.2 million into PVAF at 12% for 9.5th year, which is 0.341. Okay, G. Yeah, I think. 1 minute. Excuse me. Fair enough for people. Okay. All right. 0.2 million into 0.341. 0.682. Yes, sir. But this rate and all, no, this rate of 12% and all, it's for the whole year, right? Hence, we prorate it and make it as 6 months. This rate, what they give, 12.5 years, right? It will be generally given at whole year. So, hence 6 by 12 you do, you will get it as 0.34 1 million. This is the provision for damages due to that effluence you got it. Okay, just 1 minute. Yes, people. So this is about provision for damages for that, the production process. Okay, G. And this you will make it only on 31st March 20x4 or 2014. That's what you'll make the provision. Done. But provision for DSR, you made it on 30th September. Okay. Because the damages has been caused once the factory was constructed on that land. That construction happened on 30th September. So this provision, dates are important here. This provision for DSR, you make it on 30th September. So provision, you made it at present value, no? So as the time passes, you'll have to put up ACM table. There will be unwinding of interest table. So yeah, on this particular provision, current year, you'll have to book a finance charges. Since this damages ka provision you made at the end of the year, there is no need to book any finance charges on this. Since provision for DSR, you made it on 30th September, okay, current year, you'll have to book a finance charges on that provision for DSR. How much provision you made? 0.966. Rate is 12%. So 6 months ka finance charges you will book. You can put ACM table also. Opening balance, finance charges, payment. Payment column is anyway 0. No? So like that also we can do it, or since it's direct, I just directly put it here. This is the opening balance of provision. This is the finance charges, right? Since you made the provision only, you created this provision only on 30th September. Okay, 30th September to 31st March. In the current year, you will book finance charges only for 6 months. So do not forget the 6/12. Okay, so this is the finance charges that you will book on provision for DSR. But this provision, since you made it at the end of the year, you don't have to book any finance cost on it. Because since you have used the asset and at the end, you are at the end of the year, you're making the provision. Again, since this provision is made at the end of the year, you don't have to book any finance charges on this particular provision. But provision for DSR was made on 30th September. Okay. Hence, for 6 months in the current year, on this amount, you'll have to book a finance charges, which we have accounted here. Okay. This finance charges goes off to SPL. All right. Now they've asked the impact. So what is the total provision that you show in your balance sheet? One, if you want, you can put up ACM table also if that is comfortable for you. Year opening balance of finance charges of payment is anyway 0, closing balance. Okay, first year the opening balance of provision for DSR was 0.966. 0.966. We made finance charges of 0.0576. Payment is 0. So closing balance will be these two addition. 0.966 plus 0.0576. So it will be 1.0236. So provision for DSR will have a balance of 1.026 million. Okay, that is one provision. We have another provision for damages due to some operations of production, which is 0.341. Since you made this provision at the end of the year, finance charges will not come. So its provision balance will be same. Adding these two, this is the total provision that will appear in your balance sheet. That's what they asked over here. The only crux of this particular question is there are two provisions you need to make. One is asset related, one is not asset related. Asset related provision, you will add it to the cost of asset. Since you made this provision on 30th September, current year may you need to book 6 months ka finance charges on it. That is one. Since the second provision you are making it only at the end of the year, on the second provision this finance charges is not required. Okay, so accordingly take and do it. Fine. Yes, so that's about this question. That's it. Right, and the next set of questions are all repetitive, people. We don't have any, I don't think so we have any other new question. Yeah, I think maybe this one. Sixth question ka next part. You just need to identify whether it is a prior period item or an accounting estimate. That's all. As per the judgment of a court, an arrear of salary and wages relating to previous year, 15 lakh, will be paid in the current year. So some case is going on. As per the court verdict, we have to pay 15 lakh ka arrears in the current year. At the end of previous year, management of the company was of the opinion that arrears of salary and wages would not be required to be paid, and accordingly no provision was made. Since the case was going on in the court of law, last year company felt we will not pay the salary. We will win the case and we will not pay. Next year it turned out to be that we have to pay. So this is just an accounting estimate wala change. We did not do any error. No. Case is going on there. We thought previously nothing we had to pay. Next year we had to pay. So this is an accounting estimate change. Expense of 150 were omitted. Sir, any omission is a prior period item. You don't have to even read further. Okay. Amount of provision. Again, when you read provision, provision is always an accounting estimate change. Okay. All right. Company had taken some group insurance policy during the previous year due to mistake. Sir, don't just concentrate on the word mistake and write off error. Check. Due to the mistake of an insurance company, not ours. Sir, we are a normal company. We have taken some insurance for our employees with the help of an insurance company. That insurance company made some mistake, and due to that mistake, company paid less premium last year. Last year, company paid less insurance premium because we did not do any mistake. Insurance company did a mistake, which the insurance company is demanding to pay now. Now the insurance company is telling us, give us more premium because we did a mistake. Okay, this is an error. No, this is not error we committed. It's an error by the insurance company. So this is neither an accounting, because how much our insurance company asked, we paid. So neither there is a change in accounting estimate nor a prior period item here. We did not do any error, so not a prior period item. And we paid. We don't have to estimate. No, insurance premium and all they will tell, and we will pay. And we paid. So hence it is not an accounting estimate also. This is about your MTP 1. Let's continue with MTP 2 also. 1 minute, I'll open that file. Alright people, this is about our MTP series 2 of Jan 26 attempt. Again, a very straightforward MTP, not much to break our head. Case based question. The given story, company has some different locations it seems and all that. That's okay. Now Z Limited owns 2 vehicles on 1st July, and as per the local statute, as per the local law which was passed, which necessitated Z to undertake modification to its vehicle to enable a reduction of harmful emission. Okay, so we had to modify our vehicle because it was causing a lot of pollution. The modification should have been completed by 31st December at an estimated cost of 20 lakh. We had to do the modification by 31st December. Keep that in mind. But by 31st March 20x2, 3 months over. Deadline was 31st December 20x1. Okay, now we are on 31st March 20x2, 3 months over. But none of the vehicle have been modified, although they are continued to be used. We are using the vehicle, but modification we have not done. It is quite likely that the Z Limited company will have to pay a penalty of 2 lakh per month for illegal usage of the vehicle. Since we did not modify the vehicle but still using it, okay, we have to pay 2 lakh penalty per month, and we have illegally used it for 3 months. We had to do modification by 31st December. By 31st March also we have not done modification. So Jan, Feb, March, 3 months we have used the asset without modification. So penalty is 6 lakh. The directors intend to carry out modification by March 20x3 next year. Okay, due to paucity of funds. Fund shortage they are saying. Since we don't have funds, we are not doing modification. Question is, they are asking, should we make any provision? Of course, we have an obligation. We have a legal obligation to make provision. How much? 2 lakh every month. For 3 months, 6 lakhs. So see for Chennai is the right answer for this. Okay. Now on the next case study, they are asking how much amount will be showed in OCI for equity investment, it seems. Okay. Okay. Next one more requirement is finance cost on convertible loan. Okay. So these are the 3 parts which the case study is targeting. First para we have read. Second, I think there's something on the OCI and something on finance cost. Second para on 1st April 20x1, second, another part of the same case study. Z has issued 1 lakh loan notes of 5 each. Okay, 5 lakh is the loan. We have issued the loan, so it's like a debentures. Financial liability amount is 1 lakh into 5 lakh. The loan notes entitle the holders an interest of 8%. Okay, we have to pay interest of 8%. And annually in arrears, we pay at the end of the year. The loans are repayable on 31st March 20x5. From here to here, if you count, 4 years. As an alternative repayment, holders can convert the shares into A Limited. On 1st April 20x1, investors in non-convertible expect annual return of 10%. Compound financial instrument, sir. We are actually paying interest at 8%. Okay, due to this conversion. If this conversion option was not given, interest expected would have been 10%. So it's a compound financial instrument. We'll have to split as what? Equity and financial liability. How do you measure financial liability? Present value of future cash flows discounted at market rate. What and all is your future cash flows? 1 lakh into 5 if you do, you will get the debentures amount. And actual interest you're paying is 8%. So if you do this, you will get the interest that you're paying. Interest you have to pay every year. Okay. I mean, since the cash flow is same every year, we can use PVAF for how many years? The term is 4 years. So at the 10%, we will use PVAF for 4 years. This is your interest ka payment, interest ka cash flow plus principal. Principal, are we redeeming it at premium? No info. So we will redeem at par. 1 lakh into 5, which is 5 lakh. This you will pay only once. No? So we will use PVIF at 10% for 4th year, which is 0.683. I think it's given in the question. This discount factor, okay, they have given. This is PVAF and this is PVIF. 73.5 paisa is nothing but 0.735. This will be 0.683. We don't need 8%. We need 10%. So if they have given 3 decimals, take exactly same. Okay. This will be our financial liability amount. They did not ask financial liability. Case study is on finance cost. How much is the finance cost for first year? Put up what will be the finance cost. This is the opening balance. Calculate finance charges at effective interest rate of 10% here. This ka 10% if you do, you'll get 46,850. You can put first year ka ACM table also if you want. I've done it directly. This is the opening balance. On this, you'll calculate finance charges. Okay, and payment if you deduct, you'll get closing balance. They did not ask that and all. Hence, we have only done this. So 46,850 is a finance cost. C for Chennai is the right option there. All right, next they asked something about how much you will recognize in OCI. First, let's read the part relating to that. On 1st April 20x1, okay, Z, sir, we are currently in 31st March, I think, 1 second. Okay, let's see what they've asked. In fact, when you read the requirement, they asked how much will you recognize in OCI as on 31st March 20x2. Okay, 31st March 20x2, keep that in mind. 31st March 20x2. Okay, on 1st April 20x1, beginning of the year, Z had 2 equity investments which are valued at FVT OCA. We have gone for irrevocable option of FVT OCA. Okay. If you're going for FVT OCA, at every reporting period, you will value the instrument at fair value, and gain loss, you'll transfer it to OCA. Every gain or loss, you'll transfer it to OCA, right? The day you bought the asset, 2 investments we have. One in investment in K, one in investment in H. First K ka, we bought it at 30. Fair value as on 31st March 20x1. They are asking 31st March 20x2 ka, okay? So last year you bought the asset for 30, its fair value is 37,500. So you would have recognized last year a gain of 7,500 in OCA. Okay. Now fair value as on 31st March 20x2 next year. From this, the fair value is becomes not applicable. Why? Maybe we sold it. Check. On 28th February 20x2, the company disposed of investment in K for 50,000. Okay. All right. Now what, people? The value of that investment is 37,500. When we bought it, it is 30, but since we are valuing it at FVT OCI, at every reporting period, you will value it at fair value. From 30, we made it to 37,500 and booked fair value gain of 7,500 last year. Now, this is the value of the investment and you sold it for 50. So, how much is the gain? 50 minus 37,500, 12,500. Okay, this gain will be booked in OCI because it is irrevocable option. Okay. That is one. Next to HK, we bought it at 27,500. Last year, its value was 35,000. So last year, 35,000 minus 27,500, you would have booked a gain of 7,500 in OCI last year. They did not ask that. They asked current year, how much are you booking? From 35, it has become 38,500. So from 35, it has become 38,500 means fair value has increased. So it's a gain. How much? 38,500 minus 35,000, which is 3,500. That much gain, you'll book it in OCI. So totally relating to this investment, how much gain is totally going to OCA? One is a profit on sale, 12,500. Another one is a fair value gain. Put together totally 16,000 gain that will get recognized in OCA. A for alpha is the right option. That's pretty straightforward. Okay. Rest of is Goli. Okay. That is done. Next, case scenario number 2. Financial year is ending on 31st March 20x4. And the current year ka financial statements have been approved on 30th May 20x4. Okay, maybe something to do with adjusting, non-adjusting event could be. On 1st April 20x3, beginning of the year, company has issued 1 lakh 10 rupee bond for 10 lakh. 1 lakh into 10 is 10 lakh. On 1st April each year, interest rate fixed is 8%. Okay, yeah. Okay, interest at fixed rate of 8% is payable on the outstanding capital amount of bond. First payment will be made on 1st April 20x4. Okay. Current year will end on 31st March 20x4. Right? But interest are you paying at the end of current year? No. At the beginning of next year, you will pay interest. So interest you will pay next year. Okay. Interest is also outstanding here. On 1st April of each year, that is 1st April 20x4 onwards, next year 1st day onwards, company has an obligation to redeem 10,000 debentures. Out of 1 lakh, 10,000 you'll have to redeem starting each year. Basically 10%. 1 lakh ka 10% is 10,000. So 10,000 bond you'll have to redeem at 10 rupees. So you're not redeeming in one shot, you're redeeming in installment. Though you have raised 10 lakh rupees money, at the end of after 1 year, you have to go on redeeming. From 1st April 20x4, you have to go on redeeming 10,000 into 10, which is 1 lakh. Like this, you'll have to do. They're saying, how will you present this? Basically, current and non-current is what they're asking. 1, there is an interest outstanding. How much? 10 lakh into 8%, which is 80,000. Outstanding interest, no. As on 31st March 20x4, as on 31st March 20x4, interest is outstanding because you will pay this interest on 1st April, the very next day. So this outstanding interest will be shown as a current liability. Okay. All right. Next, the financial liability amount. How much is the financial liability amount? 10 lakh. But entire 10 lakh, will it go on for like many years? No. Out of this particular out of this particular 10 lakh, 10,000 debentures you have to redeem next year ka starting date only. At what price? 10. So out of this 10 lakh, 1 lakh you have to repay within 1 year. Because we are on 31st March 20x4, this 1 lakh you will repay within 1st April 20x4. Immediately when the current year ends, the very next day you have to redeem bond worth 1 lakh. Since it is repayable within 12 months from the reporting date, out of this 10 lakh, 1 lakh will be classified as current. Next redemption will be going on 1st April 20x5. That is 12 months. It's going beyond 12 months from the balance sheet date. So balance will be treated as non-current liability. We have done such questions. These we used to call it as current maturities of long-term debt. Pretty straightforward. Yes, similar question. Just on the classification related question this is. Okay, C Limited, one company, they are selling a machinery to customer for 2 million. Okay, payable in 90 days. C, the company is aware at the contract inception that the customer might not pay the full contract price. Sir, one of the conditions for you to recognize revenue is you should have a reasonable assurance that we will recover the money. Okay, consideration collection should be probable. Yes, though we have sold goods for 2 million, we feel customer may not pay us full 2 million. C, estimate that the customer will pay at least 1.75 million, which is sufficient to cover the cost of the sales. And the company is willing to accept because it wants to grow the presence in the market. So C concludes that it is highly probable that it will collect 1.75. Basically, revenue recognition. Same question is there in Ind AS 115 also. Basically, they're asking what is the transaction price. Will you take 2 million? No. Because entire 2 million collection is not probable. We feel only customer will pay 1.75. So the transaction price that you will take it is only 1.75 million. B for Bengaluru, right option. Same is there in Ind AS 115. Book question only this is. Okay, on 15th April 20x4, company discovers a significant fraud. Sir, year has ended on this date, but the financial statement approval date is 30th May. Before financial statement got approved, a fraud we identified. We have already studied this. Any fraud detected before the approval of financial statement is an adjusting event. So this you'll have to treat it as an adjusting event. Okay. And error always has a retrospective impact. So it's an adjusting event. We have to give a retrospective adjustment for this. This is also same, but here they said it is without. All the errors come with retrospective impact. So B for Bengaluru is the right answer for that. Okay, Ji. All right. Next, if you read one more case study, requirement is they're asking how much deferred tax. Okay, they're asking deferred tax. So let's come back to the case. Company has recognized goodwill worth 80 lakh in past business combination. So goodwill has come. In the current year, goodwill is impaired by 16. So what is the carrying amount of goodwill? In 80 lakh, 16 is impaired means the carrying amount of goodwill is 64 lakh. Okay, they have only given. Amortization or impairment of goodwill is not deductible as per the tax regulations. Okay, where the C file is written. Tax rate is 30%. Sir, when it is not tax deductible, I had told you this is like permanent difference. For permanent difference, we don't create DTA or DTL. If carrying amount is 64 lakh, tax base also we make it as same. Carrying amount is some number means same number we also make it as tax base because this is like permanent difference. On such differences, we don't create any DTA or DTL. Since carrying amount is 64 lakh, tax base also will make it 64. So the difference will be nil and DTA, DTL also will be nil. So no DTA or DTL we should create on this particular component. Very straightforward again. Okay, Ji. Case scenario number 3. Company has acquired an asset 3 years ago. 3 years we have already used the asset. So at a cost of 5 million. So originally when we purchased 3 years before, the original cost of the asset is 5 million. Okay, depreciation was 10% on reducing balance method. All right. Now people, 3 years is over. We have to calculate depreciation. One way you can do normal way or you can do in shortcut way. What is that? So you purchased the asset for 5 million. No, 10% you are depreciating, right? So what you do is 0.9 you multiply 3 times. Okay, or 90% you multiply 3 times. Why 3 times? 3 years you have used the asset. Why 90%? Sir, original cost is always 100%. Right? From original cost, if you reduce depreciation, you will get WDV, and depreciation every year is 10%. So 100 minus 10 if you do, you'll get 90%. So multiply 90% 3 times. You will get carrying amount at the end of the year. Okay, Ji, if you want, you can read the requirement once what they're asking. They're asking 3rd year ka depre. They're asking 4th year ka depre. That's what they're asking. Okay. All right, third year ka and fourth year ka debris they've asked. So, okay, this is done. At the end of third year, ABC estimates that the remaining life is 8 years. Now the company wants to go for straight line method. So till now they were used to go for WDV method or reducing balance method. From year, at the end of year 3, company estimates they want to go for straight line method. Okay. Because of the revised pattern. We know that depreciation method should reflect the pattern of economic benefits. If there is any change in pattern of economic benefits, depre method also can be changed. Okay, 3 years you have already used the asset, right? So what will be depreciation for one? Okay, from fourth year onwards, what will be depreciation? One, the carrying amount of the asset is 3.645. Correct? Now by doing this, you can do it in convention way or shortcut method like this. Take the original cost and multiply 90% 3 times. This is the carrying amount of the asset at the end of third year. Now for fourth year onwards, we have to calculate debris. How? The revised carrying amount, which is this, residual value not given 0, divided by the remaining life. The remaining life is assessed to be 8 years. So divided by 8 you do, you will get fourth year ka depreciation, which is this 0.455 or rather some amount 0.455625 million. This D for Delhi is the right answer. I've given in million. 1 million is 10 lakh. If you multiply by this by 10 lakh, you will get 4,56,250. Okay, that's the right answer. They also ask depreciation for third year. How to do it? Very simple. Sir, if you want carrying amount at the end of third year, what you will do? You will multiply 90% 3 times. Now, third year ka depreciation will be based on what? Second year ka closing balance. Because second year ka closing will become third year ka opening. On that we will calculate. So if you want to calculate depreciation for third year, do it normally. Take 5 million and reduce 10% like that if you do, or shortcut method. Take 5 million and multiply 90% 2 times. When you do this, what are you going to get? By doing this, you will get the carrying amount at the end of second year, which will become third year ka opening balance. On this opening balance, you multiply depreciation rate of 10%. You will get debris for third year. You can use the shortcut method or you can calculate in the normal method. Once again, third year ka depreciation is based on third year ka opening balance. Okay, second year ka closing will become third year ka opening. If you want carrying amount at the end of second year, multiply the 90% 2 times. This way you will get carrying amount at the end of second year or carrying amount at the beginning of third year. On this, multiply the actual depreciation rate, you will get depreciation 0.405 million or 4,05,000. C for Chennai is the right answer there. Okay, this portion is done for. Oh, next, reading the next case study. What is the next requirement? They're asking how much license will you recognize in business combination? Some gain or loss due to license they're asking. Okay, and how much is PC? Okay, those are the 3 questions targeting this case. Okay, later ABC Limited, the same company, they've acquired PQR for a consideration of 1 crore. ABC is the acquirer, PQR is the acquiree, or ABC is the parent, PQR is a subsidiary company. We have paid 1 crore as the purchase consideration to acquire this company. 4 years ago, ABC had granted a 10-year license allowing PQR to operate in Europe. So we had given a license or a franchisee arrangement where we had told the PQR company, you can use our trade name, brand name and run your business across Europe. Okay. When we had given this, 4 years back, we had given this license to them and the total license period was 10 years. The cost of the license was 2,50,000. So ABC had given a license to PQR by collecting 2,50,000 when 4 years before, and the total term was 10 years. This only we call it as pre-existing contractual relationship. If you remember, they should be accounted separately as per Ind AS 103. We have done a similar question in the class notes. The contract allows either party to terminate the franchisee at a cost of unexpired license fee plus 20%. So if this contract gets cancelled, whoever initiates, doesn't matter. Whichever party wants, they can cancel this contract. It need not go up till 10 years. You can cancel it midway, but by chance, if it gets cancelled midway, whatever is the unexpired, whoever terminates it, they have to pay unexpired fee plus 20%. Whatever is the unexpired amount, take that and add 20%. Okay. Now 4 years over. No. All right. Now 4 years before we had given a contract for how many? The total license of franchisee was for 10 years. In that 4 years is over. I mean 6 years is remaining. 6 years is remaining. Correct. All right. Now we have acquired that company. When we have acquired that company, ABC and PQR is one group. No. So we don't have to give franchisee among the same group. Right. So this franchisee indirectly gets cancelled. Okay. So we have to cancel by paying some amount. How much was it? 2,50,000 was the amount for 10 years. 4 years only has passed. So unexpired term is 6 years. So 2,50,000 is the value for 10 years. For 6 years, how much? When you prorate, you will get 150. But can you pay this? No, you have to calculate the unexpired term and add 20% to this. So 150 plus 20% if you do, you will get 180. This is a settlement value. That's how, we don't have to calculate this. They've given settlement amount is 180. That's what they've calculated. 2,50,000 into 6 by 10 plus 20%. Okay, since we acquired that other company, this franchisee is like worthless. So we have to repay 1,80,000 because we did not allow the other company to operate it fully for 10 years. No, they used it only for 4 years, 6 years. Now it's, since we have done a business combination, it's now become a worthless asset. 6 years. Hence, that's the reason we have to pay the settlement amount to them. It's a loss. Okay. ABC has acquired PQR because it sees high potential in European market and wishes to exploit it. ABC calculates under the current economic condition, the current price, it would grant a 6-year franchisee. Why 6-year franchisee? The total term was 10 years. In that 4 years has passed. So remaining is 6 years. So currently, if you give a new franchisee for 6 years, we would charge 4,50,000. Okay. Now people, there's a pre-existing contractual relationship. So you should not consider this as forming part of PC. You have to account it separately. As per business combination, you have to recognize all the asset at fair value. Now the fair value of this license is 4,50,000. They asked, at what value will you recognize the license? At fair value of 4,50,000. Okay, that's all it is. All assets at fair value. What is the loss? How much settlement you're paying? Settlement amount is 180. That is a loss. That's all is a fund. How much is the amount of PC is what they're asking. Sir, totally you paid 1 crore rupees. Totally you paid 1 crore rupees to subsidiary company. Yes. In that 1 crore, 1,80,000 you paid for cancellation of this franchisee. Since this franchisee you are treating separately, because India is 103 says, if any existing contractual or non-contractual relationship has been ended, and if you are doing any settlement, you have to account it separately. You should not consider it as forming part of PC. But out of this 1 crore, okay, for 180 is for your licenses. That means this 1,80,000 which is included in 1 crore should not be considered as PC. You have to account this transaction separately. So that means for business alone, how much have you paid? Totally for business and franchisee, you paid 1 crore because you cancelled a franchisee and as a settlement, you paid 180 extra. So PC will not be 1 crore. From 1 crore, reduce 1,80,000. 1 crore, if you reduce 1,80,000, you'll get 98.2 lakh. That will be considered as purchase consideration. Okay, very simple question again. Done. Next, what is the next case? So, next, what is the requirement? They're saying how much amount would be added to the numerator while calculating diluted EPS. Sir, how numerator is each? No? How do you get numerator for diluted EPS? You first take each for basic EPS purpose and you add a dilution adjustment, correct? No? And you add dilution adjustment. That way you will get each for depth purpose. In this question, they are saying how much will be added to the numerator. What we added to the numerator is dilution adjustment. So they are asking dilution adjustment ka value. Okay, fine. That's a question. Now check here. Accountant of ABC has calculated EPS or depth here. Net profit attributable to ordinary shareholders. This is the each for basic EPS purpose. How much is that? They've only given 12 lakh. Okay. Vains also they have only given. If you do these two, you will get basic EPS. We don't need that. They asked only dilution adjustment. Okay. We have some convertible debentures. Convertible debentures is a POS. No. POS means those instruments currently they are not equity, but in future they may become equity or equity shares. Okay. We have 6% convertible debentures of rupees 10 lakh each, and we have 1,000 debentures like that. Okay. Fine. They're convertible into 20 shares. Each convertible into 20 shares. On one convertible debentures, you have to pay 20 shares. On 1,000, how much will you pay? That is the number of shares. That's a dilution adjustment on denominator. They asked dilution adjustment in numerator. Dividend arrears, this is okay. Because anyway, they have directly given each. No. So preference dividend and all becomes irrelevant. Because after reducing preference dividend only, you will get each. Correct? So this is a not required number. Tax rate. What's a dilution adjustment? Simple. If you convert these debentures into equity shares, interest you will save. But dilution adjustment is not interest. We have to take after tax interest. We have done many questions like that. So take interest into 1 minus tax rate. So debenture value is 10 lakh, interest is 6%. 10 lakh into 6% if you do, you will get interest. Into 1 minus tax rate. Tax rate is 0.25. This way if you do, this is the dilution adjustment. Adding these two, you will get each for debts purpose. So the dilution adjustment is 45,000. Which option has 45,000? B for Bengaluru. That's all. Again, a very straightforward question. Okay. Grapes Limited, one of the company, they have acquired a subsidiary called Apple during X3, X4. Grape has to adopt Ind AS for first time on 31st March 20X3. Fine. With 1st April 20X1 as the date of transition. Great. At 31st March 20X1, the value of raw material inventory was incorrectly reported due to an error. Now, people, date of transition is 1st April 20X1. Okay. All right. One day before the date of transition, we found out that there is a valuation error in raw material. So now it's a theory question and they're saying this error is also significant. What do you have to do? Sir, if the error was in the current year, we will correct it in current year ka SPL, right? If it is the last year, anyway, we give comparative financial statement for last year, we can correct that. But if error is going beyond the previous year, right, we prepare something called third balance sheet, right? But here, since it's a date of transition, we prepare first Ind AS balance sheet. There you need to rectify it. And first Ind AS balance sheet you will prepare on 1st April 20X1. Okay, so which option is that? Here they're saying we'll correct it in X2. Wrong. We'll correct it on date of transition balance sheet, which is 1st April 20X1. This is the wrong option. X2 wrong option. X3 wrong option. The only option which has X1 is 1st April 20X1 is this. So hence D for Delhi becomes right answer. Okay, that way easily you can identify. Okay. All right. Some artificial learning and machine learning are technologies that enable computers to learn and perform tasks without being explicitly programmed to do so. They're having significant impact on accounting profession. The accountant of the company argued that the following are the benefits, but management did not agree. Accountant is saying some are benefit. Management is saying no, not all of them are benefits. What is the requirement? You need to identify which are the benefits not available, meaning which are not benefits due to artificial intelligence. One, automation. Automated data entry, yes, AI will be able to do it. So this is a benefit. Okay. Okay, benefits I will write. This is a benefit, yes. Data fraud detection, you can correct it. Financial forecasting, you can do. Privacy you cannot protect, because once you give the data in your AI platform, right, it's an open platform, so usually others also will be able to access it. So data privacy is not a benefit that you will get due to AI. So hence second option, which has that only two. So D for Delhi is the right option, meaning this is not a benefit. That's all it is. Okay, G. Fine, fair enough. So MCQ portion is done for. So let's go towards the descriptive. I think one or two more descriptive is there. Remaining all are repetitive. Bulldozer Limited is engaged in the business of heavy bulldozers. Okay. The company is willing to enter into a business of manufacturing excavators for the purpose of digging in plane of the land. For this purpose, this goal they have given. For this purpose, company acquires 25% stake in one company. Main matter. One company called Bulldozer, they have purchased 25% stake in another company. With the 25%, you get only significant influence, for which we paid 8 lakh on 1st October. Another 35% we acquired on 1st February for 12,25,000. We purchased 25 first and then 35%. So total is 60%. With 60%, you get control. So it becomes our subsidiary company. Okay, fine. So 1st February 20X2 becomes your date of control. Okay. Now this is a balance sheet of subsidiary company they have given. They've given carrying amount and they've given fair value. We always take when the date of control subsidiary ka net asset we have to record it, fair value. This is irrelevant for us. Fair value is what we need to consider. Fine. Similarly, share capital and liability information they've given. HD Excavators, that is the subsidiary, they sell small subsidiary company. They sell some small excavators under the brand name Mini Shaktiman. Subsidiary company has a brand name called Mini Shaktiman, and that brand has a fair value of 450 as on the date of control. This is a self-generated brand, and Ind AS 38 says self-generated brand or Goodwill logos should not be recognized as intangible asset. What is the subsidiary doing? There's a self-generated brand, therefore that subsidiary company has not recognized in their books. Perfect. They have not recognized, but that's okay. But now when parent acquires the subsidiary company, they would have kept this also in mind, and determined PC. So Ind AS 103 gives you a recognition exemption. Even if subsidiary has not recognized any intangible asset due to Ind AS 38 applying Ind AS 38 provision, still if any intangible asset which is not recognized by subsidiary company, still you can recognize it as per Ind AS 103. That is your recognition exemption or exception, because parent would have paid. We have solved such question. The PC will be determined, okay, also by considering this. Okay, so if PC is considering this particular 4,50,000, even this 450 should form part of net asset is what Ind AS 103 ka argument. Subsidiary has not accounted it because it is an internally generated. That's fine. But we are not applying Ind AS 38 here. When you do business combination, we have to apply Ind AS 103. Since PC considers this amount, or PC is decided keeping this brand name into consideration, this brand name also should form part of your net asset of subsidiary calculation. That is one. Now parent ka balance sheet they've given. Fine. Now you just need to pass one journal entry on the acquisition date. NCA is measured at fair value. Journal entry on the date of control. And consolidated balance sheet they're asking. A simple question, hardly any adjustment. Okay, first, what is that, people? First, let's calculate. Journal entry they've asked, no? So we will not calculate any goodwill or bargain purchase gain as a separate note. We'll put it up directly in journal entry. What is the journal entry? Subsidiary ka all net assets we have to record at fair value. What are the assets of subsidiary? 3 assets and their fair value. So check, have we debited all of them? PP, bonds or trade receivable, 22.5, 15 and 1.5 lakh. All the assets we debited. But there is one asset subsidiary has not accounted. That is brand name because it was self-generated. But can we ignore it? No. Since PC is considering this, even that intangible asset, brand name whose fair value 450 should be accounted. That is your intangible asset ka value. All assets debit. Then all the liabilities. The liability which subsidiary company has is trade payable 9.5 lakh. So this is your net assets, right? Net assets we have recorded. Okay. Then what and all we have to record? We have to record NCA. Okay. That is one. Then we have to record what amount paid. Sir, you purchase now 35% stake by paying 12,25,000. You paid 12,25,000 now. So to bank account 12,25,000. Correct? Now, before this 35%, we had 25%. Before we got control, we already had 25%. With 25%, it's an associate. And associate asset liability, we don't show it in CFS. What do we show? We show investment, right? At applying equity method. Okay, 25% we purchased for what value? 8 lakh. So currently in our consolidated financial statement, investment and associate is shown at 8 lakh. Can we show it anymore? Now it is not our associate anymore. It's our subsidiary. So existing investment, you'll have to eliminate that. How much? 8 lakh you credit it. So you'll credit investment and associate at 8 lakh. Okay, Naji? Fine. If you want one more thing we can do, I'll get it as balancing figure also, it's fine. Okay, now NCA will have to show. No, they have not given. They said NCA should be valued at fair value. But they have not given the fair value of NCA anywhere. How to find? Simple. You got control when you acquired 35%, correct? We got control only when we purchased 35%. For what value? 12,25,000. That means for 35% stake, the fair value is 12,25,000. You agree? You'll always buy the shares at fair value only, no? Okay. So 35% stake you have acquired recently by paying 12,25,000. How much totally we have? As parent, we have 40%, means NCI has 40%. So for 40%, what is the fair value? Like that, proportionate. For 35%, for this 35% of the fair value is 1225. For 40%, how much? 12,25,000 into 40% divided by 35%. If you do, my calculator showing 14 lakh. That's the value of NCA. Directly, I've shown it here. 12,25,000 is a fair value for 35%. For 40%, how much? Okay, Ji. Okay, this is one. Now, two more components will come. One is goodwill, that you can get it as balancing figure. You can put separate working notes for all of them first and then do entry. In the interest of time, I have skipped the note and I've directly do it. Goodwill, you can get it as balancing figure, but hang on. Associate, earlier it was an associate company, no? Because with the 25%, we had SI. Now, after you purchase 35%, significant influence you lost. Whenever significant influence is lost, there will be some gain or loss. That gain or loss goes off to SPL. That we have to find. Okay, how? Compare the carrying amount with the fair value. Okay. So what is the carrying amount of our investment? The carrying amount of our investment is 8 lakh. They only given. We purchased that 25% for 8 lakh. Okay, now Ji, this is the carrying amount of investment. Compare it with the fair value. What is its fair value? We do this in many questions, right? 8 lakh, okay. Say same drama. Now we want for, this is a 25% investment. Okay. When we, on the date of control, we purchased 35% stake by paying how much? 12,25,000. So for 35% stake, the fair value is 12,25,000. We purchased 35% stake by paying a fair value of 12,25,000. Earlier we had only 25% now. So for 25%, what is the fair value? Same proportionate. Okay. We found out NCA using proportionate now. Same thing. For 35%, if this is the fair value, our existing investment was 25%. For 25%, how much is the fair value? Proportionate. 12,25,000 into 25 divided by 35. You'll get 875. Okay. Carrying amount is 8 lakh. Fair value is 875. So it's a case of gain. We bought it for 8 lakh, its fair value is 875, means this is a gain on significant influence lost, which will be transferred to SPL. So you'll credit SPL by 75,000. That's as per working note number 1. Okay, Naji. Simple, straightforward. We have done enough number of questions like this. Yes. Now journal entry will not match. Balancing figure is goodwill or bargain purchase gain. Debit side balancing figure will be goodwill. Credit side, if you get balancing figure, it is bargain purchase gain. If you don't like this approach, you can put up a separate working note for goodwill. Like you can put net asset ka working note, net take PC, okay, excuse me, take PC, then you take NCI, compare it with fair value of net assets, and then calculate goodwill. Okay, like that also you can calculate and do it in conventional way, or you can do it straightforwardly like this. Since they asked entry, I got goodwill as a balancing figure, but you can put up a note, absolutely fine with that. Okay, Ji. Alright, then they ask consolidated balance sheet. Consolidated balance sheet is very straightforward, sir. Hardly anything is there. Okay, take what? Parent ka value and add subsidiary ka assets. Now, parent ka bulldozer PP value is 40.5. To this, you add subsidiary ka value, but don't take subsidiary ka assets at carrying amount, but take fair value, which is 22.5. Add it. Here only I'll do. This is parent ka, this is subsidiary ka. So, this is the value of PP in consolidated balance sheet. Okay. Investment in HD. HD is our subsidiary. Will investment in subsidiary come? No. Instead of that, what will come? Goodwill. So instead of this investment, okay, this investment will not come, but goodwill will come for 1 lakh. That is one. Then subsidiary has not recognized one intangible asset called brand name. But since this has come due to business combination, we have to recognize. What is that brand ka fair value? 4,50,000. So another intangible asset called brand name will come for 4,50,000. That's another one. Okay. Then trade receivables, parent ka 240, subsidiary ka 150. Okay, parent ka 240, subsidiary ka 150. If you add, you will get 3,90,000. Okay, cash and bank, parent ka 1560, subsidiary does not have any cash, so 1560 plus 0, 1560 only. Does subsidiary have any other asset? Yeah, subsidiary has some bond investment worth 15 lakh. That will also come in consolidated balance sheet. 15 lakh bond. This is your asset side total. Quickly I've done, hardly anything over here. Okay. On the equity liability side, only parent ka equity share capital will come 15 lakh plus reserves. Reserves, no. Sir, if one good thing about here is your date of control is 1st February. Date of control is 1st February, and they have asked you to prepare, consolidated balance sheet on 1st February only, on the date of control only. Usually we prepare consolidated balance sheet at the end of the year. Right? Or maybe this is the end of the year, we don't know. Okay, could be anything. Okay, but they've asked us to prepare balance sheet on 1st February, and 1st February is only date of control. That means any reserve which subsidiary company has some this much reserve, all will be pre-no, right? Pre-acquisition profit will not have any impact on retained earnings, right? It will be considered for net asset calculation, right? So this will not have any impact. We don't have any post-acquisition reserve of subsidiary company. Hence, when you prepare in consolidated balance sheet, other equity working note, you show retained earnings, general reserve, capital reserve and all. You take opening balance, you add total comprehensive income, add post acquisition profit from subsidiary. Here, post acquisition profit only is 0, means post acquisition share is also 0. That will not have any impact. Okay, that means parent ka reserve will come 35,25,000, but you lost SI. When you lost significant influence, how much did you transfer it to SPL? 75,000. SPL only will get reflected in balance sheet as retained earnings now. So retained earnings will not be 35,25,000 plus gain due to significant influence loss. You will book of 75. Add 75,000 to this. You will get 36 lakh rupees. That's one adjustment. Do not forget that. This is the gain due to significant influence loss. Okay. Because post acquisition profit is not there, we don't have to worry too much about the working notes. Straight away we can do it. Short term loan. Does subsidiary have any short term loan? No. Parent ka 12 lakh, subsidiary ka 0. So total will be 12 lakh. Trade payable. Parent ka 9 lakh, subsidiary ka 9.5 lakh. 9 plus 9.5 is 18.5 lakh. Other current liability, parent ka this much, subsidiary ka 0. So total is 7.5. In consolidated balance sheet, NCI also will come. NCI balance is 14 lakh. Sir, this is the NCI on the date of control. right? But we don't have any post-acquisition profit because we are preparing balance sheet on the date of control itself here. So NCI balance will be same, 14 lakh rupees, NCI also will come. Okay, G. Total of both side of consolidated balance sheet matched out. Okay, I've done it quickly here because hardly there is any adjustment. If you want, you can do it in the normal consolidation format. Okay, shareholding percentage, net assets, so analysis of post-acquisition profit, like that. You can put all the working notes also and do it. But since there is no adjustment here, I suggest the shortcut method to save some time. But anyway, that is your call. Okay, sir. That's all with respect to this consolidation question. Okay. Now, next one. This question is actually repetitive, but I feel there is a small error in this question. Because of that, I will do it. Otherwise, we have done 2 questions like this in our regular class. Vidhi Bank has agreed on 15th April to sell $60,000 US to Satvik Limited. A bank has agreed to sell dollars to a company. First check, we have to do accounting for bank or company. Usually it will be for company only. Check. Okay, in the books of Satvik Limited, they are asking. Okay, 2 things they are asking. Analyze with reason whether an agreement contains any derivative. First, they are asking, is it any derivative? Now they are asking the journal entry for that derivative transaction for the company, not for the bank, for X1, X2 currently. Okay, till the date of actual purchase of US dollars. Okay, so we are actually purchasing US dollars. So if you actually purchase, it will be gross settlement. If you settle only gain or loss, it is net settlement. Both the types of scenarios we have done in our regular class, right? Okay, let's go through. So that means if bank is selling dollars, means Satvik is buying. So think from company's perspective. Company wants to buy dollars. Okay, this is the agreement, but the actual buying and selling will happen on 31st March 20x2. Okay. On 15th April 20x1, bank and company has agreed, they've entered into a forward contract that they will execute this contract on 31st March 20x2, maybe almost 11 months later. And Satvik will buy $60,000 for 82.40. Vidhi Bank did not receive any amount upon entering the contract. Okay. First question they asked, is it derivative? Sir, derivative means it should have few features. One, the contract should not have any value. Its value should depend on the underlying asset. Here, okay, this particular contract as such does not have value. Its value is derived on the dollar ka rate. Okay, so it is depending on the underlying asset. Settlement is on a future date. You made contract on this date, but settlement is later. So settlement is happening at future date. Then initial investment is 0 or nil. We did not pay any amount. So initial investment is 0. So derivative ka all the 3 features are satisfied. So the answer to the first question is yes. Just don't write yes, write derivative ka condition and then say yes, this contract is a derivative. And for derivative, we follow FVTPL accounting. Okay. Now we know forward contracts except options, right? Options will have a fair value on the date of contract. But other than options, forwards, futures and all will not have any fair value. So on the date of contract, since there is no fair value, we don't do any accounting. So they've given some data. Check. On 15th April, forward rate is 82.4. Spot rate was 82. Obviously, no bank will agree to buy it at spot rate. The rate will be different. Yes. Okay. On 30th June, maybe the company is following quarterly reporting here. On 30th June, first quarter ended. Forward rate is 82 points. Spot is not 11. Q2 ka rate is 82.15. Q3 ka rate is 82.5. Q4 is a settlement date. Ideally, these 2 rates should be same. Okay, it should not be different, but anyways, let's not question the question. Okay, so spot rate I will take and do the accounting here. Okay, ideally these 2 rates should be same. Okay, fine, because you are on the settlement date, so this exactly should be same in my view. But anyway, I will take 82.5 and do the accounting here. Now it's a forward contract. Initially, no one paid any amount. There is no premium paid at all. If any premium has been paid by one entity to another entity, that premium becomes fair value, and you will do the accounting for it. Since no amount was paid, on 15th April, this contract does not have any fair value, so no entry is required. Okay, that's the thing. Now on 30th June, first quarter has come. First quarter ending has come. Now think, Satvik Limited. Okay, you just have to analyze whether for Satvik Limited, it's a gain or a loss. Bank is selling. So Satvik is purchasing. Satvik, the company, they have made a contract that they will purchase it for 82.4. Okay, but on 30th June, the forward rate is 82.10. Okay, 82.10, meaning we are purchasing dollars at 82. To purchase $1, we are giving 82.4 rupees. But others can enter a similar forward contract just by paying 82.10. Others can buy dollar just by paying 82.10, but we have to pay 82.4. So we have to pay more. That means for the company, there's a loss. Loss means we book derivative financial liability. So entry is SPL account debit to derivative financial liability. How much loss? We have to buy it. We have made a contract to buy it for 82.4. Others can buy the same forward contract on 30th June for 82.10. How much is the loss? These took a difference. 82.4 minus 82.1 or 30th June, no? Right? 1 minute. 30th June, sorry. 82.40 minus 82.1. Okay, if you do it, you will get 0.30. So for $1, 0.30 rupees is a loss. This is the contract for $60,000. So into 60,000, if you do, you will get the total loss, 18,000. So first quarter ended, the loss is 18,000. Entry is SPL account debit to derivative financial liability. Okay. Now same drama till the settlement, you'll have to do the accounting. Now second quarter has ended. Second quarter mein same drama check. We have agreed to buy it at 82.40. For second quarter, the rate is 82.15. For us to buy $1, we have to give away 82.40 rupees. But others can buy second quarter just by dollar by paying 82.15. So what is the loss? 82.40 minus 82.15. Correct now? 82.40 minus 82.15. The loss is 0.25 for $1. For $60,000, the loss is 15,000. Correct? The total loss is 15,000. But last quarter we have shown derivative. Sir, if fair value loss is 15,000, we have to show DFL in our books. To the extent of gain or loss, we show. If it's a gain, we show derivative financial asset. If it's a loss, we show derivative financial liability. Last quarter, we thought total loss was 18,000. So we booked derivative financial liability for 18. But second quarter, the total loss is only 15. Means the balance in DFL should not be 18, it should be 50. Because second quarter total loss, there's a total loss is 15,000. But we have DFL balance 18. So what to do? From 18, we have to bring it down to 15. Liability has credit balance, sold entry. DFL account debit to SPL 3,000. How 3,000? 18,000. We are currently in our books, liability value is 18. Required is only 15. So we'll pass this entry for 3,000 rupees. This is the second quarter ka drama. Now third quarter, we have agreed to buy it for 82.40, 31st December. Others can buy dollars by paying 82.50. We can, to buy $1, we will give only 82.40. But others on 31st December, they have to give 82.5. That means we will have a happy face. Because if you had not made forward contract, we would be paying extra. How much extra? 82.5 minus 82.40. So the loss is 0.10 per dollar. For 60,000, it is 6,000. This much loss we have avoided. So it's a gain for us. Because we will buy it for 82.40. Others will buy it for 82.5. This is the gain. Gain means we'll have to book derivative financial asset. So in this quarter, on this day, we will book derivative financial asset for 6,000. But hang on. Till last quarter, we already have DFL. How much DFL we have? Here credit 18, here debit 3. DFL balance previous, till now we have how much DFL balance in our books? 50. We thought it was a total loss of 15. So we have DFL, we have recognized DFL in our books to the extent of 15. Is this loss there anymore? No. That means reverse DFL. It has credit balance. So you will debit DFL by 15 and close it. Because it's not loss anymore, it's a gain. So this is the gain wala recognition. If it's a gain, you'll recognize derivative financial asset. Whatever loss you booked previously, you need to reverse by debiting it. It will be done through SPL. That's all it is. Done. Okay. On 31st March, that's a settlement date. Okay. Now, two things will happen here. One, cash in the form of INR will go out. And cash in the form of US dollars will come in. Because you're purchasing. No? You're purchasing dollars. So cash or bank account in the form of US dollars will come in. Bank account in the form of INR will go out. Okay. Now let's calculate this. Now bank account debit. Now US dollars is coming in. How much dollars did you purchase? 60,000. Okay. You are purchasing it for 82.4. But what is the value of dollar? On the day you are purchasing the dollar, the spot rate or the value of the dollar is 82.5. 82.05 rather. The value of $1 is 82.05 and you are purchasing $60,000. So bank account debit 82,000 into 82.05, which is 49 lakh 23,000. This the dollar value that will come in. Okay. Okay. Since you are actually purchasing it, okay, dollar cash will come in. Cash in the form of INR will go out. This is dollar cash coming in, which we have debited. Okay. Now we have settled it. Since it is settled, DFL is already cancelled. If you just check, Here credit 18, here debit 3. So DFL balance was 15. And here you debited by 15. So DFL balance, if you check, has already got nullified. But we still have derivative financial asset. So till the time of settlement, you will show derivative financial asset or derivative financial liability. Once a settlement is done, DFA, DFL not required. Here we have DFA worth 6,000. Cancel it by crediting DFA of 6,000. This entry we have done. Okay. Now in order to buy the dollars, we have to give INR. So bank or cash in the form of INR will go out. How much? Sir, this I feel is an error in the ICI thing. Sir, we have made a contract to purchase $60,000 by giving how much INR? To buy $1, we have made a contract to pay 82.4. To purchase $1, our forward contract rate is 82.4. That means to buy $60,000, how much INR we need to give? 60,000 into 82.4, which is 49,44,000 worth Indian rupees we'll have to give away. Okay. And balancing figure is the net gain or loss on settlement, which will be adjusted through SPL. This you'll get it as balancing figure. Okay, according to me, this should be the treatment. But I think there's an error in MTP. What they have done is, instead of taking 60,000 into 82.4, they have done 60,000 into 82. They have taken this rate, this forward rate. Sir, we did not make forward contract for this. This is, first of all, this should not be 82. Both these rates should be same. That I feel is wrong. Next, even if the rates by chance are different, we have not made forward contract to buy it at 82. Our price is 82.4. But by mistake, I feel ICA is multiplied it by 82. I feel it's an error. Okay. Hence, this answer, final answer will not match journal entry wise. But I feel what we have done is right over here. We have two questions like this in our ICI material only. And many RTPs and all, we have seen this question. So I feel this is a correct treatment for this. Okay, sir. Yes, I think remaining all questions are repetitive, people. 1 minute. I'll quickly confirm it for you. Yes, people, congratulations. Remaining all questions are repetitive. We don't have anything new there. So wish you all the very best for your examination. Take care.